Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic is 3 reasons that people lose money in shares.
Thanks, Michael.
Again, not an exhaustive list.
But I feel like we always have to clarify these aren't the only 3 reasons, but these are probably, there's a million reasons people can lose money investing in shares, but most of them tie back to these 3 kind of root causes, I guess. So That's kind of weird. It's a very glib title, but
because it's the main ones that we see. Yeah. The main reasons that we see, and it's something that we hear often. Potentially new clients will come in to meet with us, and look, as part of the means to getting them to where they need to be, will include investing in the most diversified companies around Australia and the world. Oftentimes the retort to that will be, oh, but I know someone, my best friend, who lost everything in shares. And when you actually dig a little bit deeper, we're actually talking about chalk and cheese, because what we're recommending
is very different.
Is vastly different to what their friend who has experienced some bad results has done.
That's a good point. And I think, as you said there, most of the time when people come in and see, I think there's a perception that if you go and see a financial advisor, they are going to tell you to invest in shares. And in most cases, that is true. But it's not because we love investing in companies or that we get a thrill out of it. It's just that for most people, they need to be invested in a way that's going to give them a higher long-term return than what they would get from term deposits and cash. And investing in, as you said, a diversified group of companies in Australia and around the world is going to be potentially one of the ways to get the return that they need. So it's really a situation where if someone came in to see us and they had $10 million in the bank and they wanted to live on $60,000 a year, then they probably don't need to invest in shares at all.
No.
They do not need to be invested in companies at all. But for most people who are coming in to see us, it is a part of their strategy is how do you invest the retirement savings that you've built up now. And for most of our clients coming to see us, they are contributing money into super. They are saving some of their money over the last years of their working life. They need to be investing that money in a way that gets them a return.
Absolutely. Look, it's there for a reason, and there's quite a few podcasts that we have already where we talk about how to draw an income from retirement.
That's right.
In retirement. So we talk about the average amount of money that people will draw per year in retirement is $70,000 to $80,000 a year. So again, using a really, really simple example, if you currently have $1 million, and that's invested in what people would consider low risk, which is effectively bank accounts and term deposits, the current rate of return that's going to generate about $20,000. That $1 million is going to generate about $20,000 of income for you. And you're going to draw $70,000 to $80,000 in the first year of your retirement. So you're going to go backwards straight away. When I go and look at a really, really diversified, and the actual results of a diversified group of the top 200 companies in Australia and the top 1,500 companies in the world, if I go back to 2005 and look at that all the way to the end of the 2019 financial year, the average rate of return with the global financial crisis smack bang in the middle of that has been 9.08% per annum. Now, just to be clear on that, that's looking at the 60%, so the money that you have invested, 60% of that in the largest 200 companies in Australia, 40% of that in the largest 1,500 companies in the world, excluding any Australian companies that could be doubled up in there. and unhedged the Australian dollar. So the average rate of return has been a bit over 9% per annum over that period of time. So again, using that simple analogy, you have $1 million, you need to draw $70,000 or $80,000. It generates you $90,000 on average over that
that's
period of time each year.
So a very simplified example, but it gets to the point that you, as we've said there, is that we wouldn't be recommending people invest in companies and in growth assets and have to go through the volatility and some of the pain points of investing in companies and in shares if you didn't need it. As we said, if you had enough money to be able to live on a 2 or 3% return, then more power to you, just do that. But for most people, there is just no other way to get the returns that they need to have enough in retirement savings without investing in shares.
That's right. And look, property is too illiquid, and it's I would argue with anyone that it's just not as good.
I thought you were going to try and be nice about it.
No, I'm not being nice at all.
And residential property is not a good investment in terms of your retirement savings.
And it's just not going to pay you enough rent to be able to
give you the lifestyle
give you the lifestyle that you actually need.
So
the only answer that we know of is for the majority of their clients. They need to have a lot of their money spread across those really, really good companies. Now, they are volatile.
Yes. And so
those companies will move up and down.
And so I think that's exactly it. Like so I guess same old story. We've said we're going to have a podcast about 3 reasons people lose money in shares, and we've talked for 10 minutes. And we haven't even got to this intro.
I feel like this is
I think the structure it's actually worked well, because so we now arrive at a point where for most people, what they need to be invested in with their retirement, with the bulk of their retirement savings leading up to and into retirement, is the last thing that people want to be invested in, and we understand that.
Yes.
This is not new information. When someone comes in and says, "I'm really nervous about that because I got a friend that lost a lot of money in shares," like we understand. Like we've heard all the stories. We know we have heard all these horror stories of things going wrong. We know that can happen. We're well aware of that, and we're still usually recommending that you need to be invested in a fair portion of companies. And so really, once we've arrived at that point of we have to be invested in these assets, this is where I think the main thing. It then becomes a process of elimination of, if we have to be invested in these companies and in shares in these companies, how do we avoid the main things that, if you look at this problem backwards of, okay, well, we want to be invested in shares, we don't want to lose a lot of money, like my mate down the street or my neighbour or whatever. So what are the reasons that people lose money, and how do we avoid that?
Yeah, so the first reason that we have come up with is, and these are the 3 main common things that we see. We should point out. So people are under diversified is the number 1 reason. So how that manifests itself usually is that they've bought one thing or one company. Or even worse, not even one company, one commodity. So they've bought gold. Now the difference there is that I'm not going to digress too much, but a company
don't get started on gold, mate.
I mean, you can be under diversified by owning one company, but at least one company has something to offer, or should have something to offer to the public, and it should make a profit.
I feel like this is going to digress into a debate about Bitcoin.
We're not going to leave it any further. But
so in the company example, the way that I guess that's what, like we said, one of the main reasons, or one of the, when someone says, my friend lost a lot of money in shares, and you dig a bit deeper and, okay, what happened? Well, they had this mate who had a cousin who was working on this mine site in the Pilbara somewhere, and they said, we've struck gold, or we've got this new product that they're going to, this mine site's going to take off. This junior mining company is going to be the next big thing. It's going to be the next BHP. And they've loaded up and put the house on one specky mining company they've bought it at 2 cents a share, and go, geez, that's cheap. It's 2 cents a share. I'm just going to buy that one company because it's going to be the next big thing. And the company has gone bankrupt.
That's right. So it's gone bankrupt. So there's really 2 forms of this. The company goes bankrupt. So your investment. It's not an investment. Your speculation. Your speculative.
Your gamble on that company
has gone to zero.
Yep.
So that's one. That's one. The other one that I see is quite common, is not that it's gone to zero,
Yeah.
but people have actually put a lot of money into it at the wrong time.
Yep.
And these are some of the biggest companies in the world. So you know, it's not uncommon to see people throw everything at Apple shares or Google shares or Netflix.
Yeah, that's a good
or
point.
any of those. So some of the biggest companies in the world, people will actually buy usually at the wrong time when everyone else has already pushed the price up. So
that's a good point, because it's when we're saying being under diversified, it's not to yes, you probably shouldn't put your whole net worth into a specky mining company, but you also shouldn't put everything you own into Google or Apple or Berkshire Hathaway or some company that's been around for 100. It doesn't matter.
Examples.
It doesn't matter what you invest into. You shouldn't have all of your net worth in one company.
In one company, and there's in the past in Australia, for example, there's been an assumption that a risk-free investment was to put everything into Commonwealth Bank or to NAB. Now, you could have done very well out of that. But there are other people that have invested not so long ago that have done very poorly out of that. And
it also ties.
It may never come back. It's
and
not that they've lost everything. It's that they've bought a lot at $10 a share. And it's currently at $3 a share.
That's right.
And may never come back to.
And that's, I guess, if you look at any sort of industry or any sort of economy, you have creative destruction everywhere. So CBA over the last 100 years has made huge amounts of profits, but no one's sitting on their hands going, gee, CBA's making a lot of money, we won't get into banking, we'll let them make all the money. There's always those competitors coming out trying to cut their lunch. And this is, I guess, the point we're saying is, even if you look at, if you're retiring in 10 years' time and you're going to live for 30 years in retirement, you really need to be invested in a way that you can stay invested for 40 years. So will CBA still be the number one bank in Australia in 40 years' time? I got no idea. And I don't think anyone really does know. And I guess the whole point is that if someone thinks they know, they're kidding themselves. So we don't know what will be the bank of choice, or even whether they will have banks in a different format in 40 years' time. So we cannot just put all our eggs in one basket and just say we're just going to own CBA shares.
Yes, and under diversified, I mean, there is a saying as well that greed and fear
that's right,
really intertwine, and I've seen that in the past. So being under diversified is a example of pure greed. So it's saying I'm going to forget about getting average returns. I'm not happy with the average of the ASX 200, which happens to be somewhere in the vicinity of, let's call it 10% a year over a long-term period of time.
I want more than that.
I want 50% a year. So it manifests itself in greed. It's a funny one because it also, people can't believe that it could ever go backwards. So it's one of those things that I see. They'll see, recent examples are your Netflix type of companies and so forth, those type of technology companies. People just think this is going to be the next biggest thing, and there'll be no competitors. They'll forever and a day be able to make massive big profit margins, and there'll be high growth. So they throw everything at it and they just can't believe that it could ever go backwards until it does.
And that's a really good point there. Is that it's not, it does manifest itself as greed, in as much as what you see a lot here is that when we say to people the way that you should be invested is in a very diversified portfolio of say in this case Australian companies and international companies, and then this is something that we look at is every year one of those will outperform the other. Either the Australian companies will perform better than the international or vice versa. The human instinct is to go, well, I want more of the winners and I want less of the losers.
That's right.
I just want the one that's outperformed because I hope it's going to outperform again next year. That cannot happen over time, and that's where the greed part of it comes into it. Is that diversification means that you're never going to make a killing, but you're never going to be killed.
Yes, I just thought of that as well. Like I was going to say, there's a great Nick Murray saying called "Dallas, you beat me to it." So can't make a killing, can't get killed.
And that's, I guess, the point of what we see a lot. Whenever I, especially with existing clients, when people want to be under-diversified, based on, I guess, my sort of thoughts of under-diversified, it's normally in response to, I've just said to someone, hey, you are not on track to where you wanted to be retired, or you're not putting enough money away, or you're not doing your side of what needs to be done.
Yes.
And normally, again, that's painful. We don't want to do that. I don't want to give up more money. Can't we just get a better return? Don't you have some hot share tip that can just double in value in a year's time, and we can just do it the easy way? There is no free lunch. So if you are going to try and double your money in a year's time, you could also lose the lot.
That's right, and we have a belief here as well that the more that you accumulate, the more you should be diversified. So if you have $10,000 and you want to put all of that, if your life savings are $10,000, as painful as it is to lose your life savings at that point in time, the maximum you can lose is $10,000 if you put that into a speculative investment. Now, if you have $1.6 million,
you put all that in
towards the end of your working life before you retire, and you have that all in a speculative investment and lose a lot, then it's obviously going to be far more devastating.
Well,
so the more that you accumulate, the more you want to be diversified.
And I think the main thing with that is that it may not even necessarily be about the dollar amounts. It's probably more around how long have you got to make it back? You know, if you're 21 and you've got $10,000 and your mate's got some specky mining company, and you lose a lot of that 10,000, it's probably painful because you've saved working at Woolies all through your teenage years to build that up. You've done all this and you've lost 10 grand, but you're fine. You've got 40 years to make it back.
Again, probably digressing, it may actually be the best thing for you.
Well, that's right.
You've learned a valuable lesson really early on. You'll never again risk big sums of money.
That's right. You'll never again put 100% of your net worth into one thing.
So so under diversified is certainly one of the big things that we see, and it can either go to zero, your what you've put in there, or it can languish well below what you've put into there for forever. Basically, it can halve in value and stay there. It can do plenty of those different things. So, number two, the second reason that we see that people panic. So they panic at the wrong time. And I think people actually get volatility and risk mixed up. So if you're well and truly diversified, and we'll go through some figures in a minute, and we'll look at the global financial crisis as an example. But if you're well and truly diversified across, like I mentioned before, those top companies in Australia and top 200 companies in Australia, top 1,500 companies in the world, we would say that they're volatile in that the price will fluctuate. But it's always, anytime it's dropped in price, those things that you're invested into, they've actually managed to recover and grow to new highs. So there's never been a time. We would say that's an example of volatility. Whereas if you put everything into that speculative mining company, it can turn to zero and never come back. That's an example of risk, which is permanent loss. So there's a big difference. People often say to us, is that high risk? And we would say, well, it's high volatility, not high risk.
It's a really good example of, and that ties into and that's, I guess, what we'll get through, is that all of these reasons tie in together, is that you are much more likely to panic if you are under-diversified, because if you're invested in the top 200 companies in Australia, if you're invested in the 4 big banks and CBA, something goes wrong with them and they start to lose money, you are less likely to panic because you are invested in these other big banks that are going to come in and take their customers and take their profit. So the panic stations just normally aren't there because there is no decision to make, if that makes sense. So that if CBA loses those customers, loses the profit from those customers, you own those other assets that are going to pick that up. So it's not the end of the world. Whereas if you just own CBA shares, you do have to be watching that like a hawk and going, is this it? Is this them going, are they on a death spiral here that they're not going to come out of? Whereas if you own all these different companies, the only way that you can actually have your investment go to zero is if all of the 200 biggest companies in Australia went to zero, became bankrupt. And that's kind of one of those, as I say to people, if that happens, we're all living in caves wearing animal skins. So we've got bigger issues.
That's I mean, when you explain that to people conceptually, they can understand that conceptually.
Yep.
When they're actually living the moment, like they still panic.
Yes.
And so volatility
Yep.
is, like we just explained before, is the movement down, the movement back up
Yep.
of that can be deadly to someone who panics at the wrong time.
That's right.
So what I saw a lot of in the global financial crisis, which bottomed out in March of 2009.
Yep.
I saw quite a few examples of people panicking. I worked at a different financial advisors firm at that point in time. Quite a few of our clients that we thought were probably the most least susceptible
Yep.
to panicking
Yep.
actually
Yep.
panicked.
Yes.
And it was just by sheer weight of news at
Yes.
that point in time. So the media really jumps on board.
Yeah.
And they sell a lot of newspapers. And a lot of advertising at periods of time when there's volatility, when things are going back. So if we look at from the absolute high of the Australian, of those top companies in Australia and around the world, from the absolute high to the bottom was a drop of about 57%. So to the high, from the previous highest point, which occurred in November 2007, to the bottom, which occurred on about the 9th of March 2009, from memory, was a drop of 57%.
And that's I guess you make a good point there, is because it's very easy to sit here and go, 57%, but it's a very different lived experience to go, I have $1 million invested in Australian companies.
Yep.
Now I've got $430,000. That's you can understand why this happens. You can understand why people panic, because human beings, we are extrapolation machines. You know,
Yes.
and that's what we do, is we look at what has been happening, and then we extrapolate, continuing on from that.
Yes.
So my investment has dropped from $1 million to $430,000. At this rate, it's going to go to zero.
Yes, that's what happens. People can't understand. They can understand it conceptually.
Yes.
They feel they have to do something.
Yeah.
They have to do something right now because they just cannot stand it.
Yeah.
So, look, it can be very dangerous for people if they panic at the wrong time.
Yeah.
Because recognise that the price of anything is a function of how many sellers there are and how many buyers there are. So what happens at the very bottom of the market cycle, when the prices are at the lowest, is when you have the most people panicking.
Yeah.
Because after that last person
Yes.
has panicked,
Yep.
no one's left to panic.
Yeah. There's no one
Then
selling.
there's no one left to sell.
Yeah.
What you find is that prices start to rise then, and the
Yeah.
buyers start to panic
Yeah,
because
they're
people that
gonna-
are sitting on the sidelines waiting for the bottom
Yeah.
have suddenly worked out that they think the bottom's already come and gone.
Yeah.
And they're starting to pile in now.
So you got more buyers
So,
than sellers.
so there's a lot more buyers than sellers.
Yeah.
People that were going to panic
Yeah.
no longer panic because hey, the price is going back up again. So that's why you see such extremes.
That's I think, and I like the example that you've used here before with clients of ours is about panic. It's a very human emotion, and again, it's completely understandable why that happens. But if you think about it logically, if you are not able to ride out that volatility, and if you are not going to be able to sit through that, as you've said before, if you're going to panic now. Panic now while the market's up.
That's right.
While we've had years of positive returns in a row, don't wait until the price is halved to panic.
No.
That makes no sense.
Because recognise what you're doing when you're panicking is you're selling something that was worth $1
Yeah.
and is temporarily
Yeah.
valued at 43 cents. That's
Yes.
a 57% drop.
Yeah.
And you're saying,
Yeah.
I'll sell now at 43 cents.
Yeah.
And I mean, another phrase that you'll hear from people quite often during during the global financial crisis is, hey, why don't we just get out? We'll just get out now, and we'll wait till things settle down and get back in. And I'd say, okay, this is what you propose.
Yeah.
You propose to sell
Yeah.
at a 57% drop.
Yeah.
So you're selling for 43 cents.
Yeah.
And you're going to wait till they get back to $1 and you're going to buy back in.
Yeah.
Now, it sounds absurd.
Yeah. When you sell.
And
Yeah.
to say it that way.
Yeah.
But I mean, a lot of people didn't understand what that actually meant, and the ones that did understand it still just like a lot of people still couldn't hack it.
Yeah.
So they actually panicked out. So
it's interesting and it seems. Maybe it isn't, but it seems specific to shares, this impulse to panic, because
it's absolutely look. There's. I was just thinking of this before. Yeah. Volatility is absolutely all around us.
Yeah.
The only thing that's not volatile is money in the bank.
Yeah.
And that's why the rate of return is so low.
Yeah.
Because it's a guaranteed rate of return. So
Yeah.
the price of groceries is volatile.
Yes.
The price of bananas is volatile.
I was waiting how long until you brought up the price of bananas. That's your go-to move.
Well, your house. If you try to auction your house.
Well, that's kind of what I mean. Leading up to the GFC, someone had $1 million house.
Yep.
If you tried to sell that house at the depths of the GFC, you might it might not have been that extreme, but you might have sold it for, someone might have offered you $600,000.
Yep.
And this is, I guess, the other thing is where you're saying before with that news being in real time. If you have the example of your house, and you've actually used this example before, so I'm going to crib it, but if you own a house that you purchased for $1 million, and then next week someone comes and stands on your lawn and says, "Hey, nice house, I'll give you $800,000 for it," you'd go, "Get off my lawn, creep."
Yeah. But you'd kick them out.
And then next week they come and go, "Nice house, I'll give you $700,000." And then the next week they go, "Oh, things are looking pretty good, I'll give you $850,000. You just go away.
Yeah, that's right.
I bought this house for the long term. I don't care what it costs, what it's worth day to day. You wouldn't have that person come on your lawn and say, "Oh, geez, the market's down. Your house is worth $430,000. Here, I'll give you that." And you wouldn't then say, "Great, I'll sell to this weirdo who keeps turning up on my lawn. I'll sell to him, and then when the house is back being worth $1 million, then I'll buy it back from him."
That's right. Yeah. No, it's completely. The only thing that I ever see it in is companies. So investments and shares companies is the only thing where I see that people panic when the price goes down. They obviously don't panic when the price of bananas goes down.
No, that's right.
But they don't hoard either. No. They don't actually go in there and hoard bananas.
No, that's right.
I mean? The price is going down. The price of the house goes down. They don't panic out of that. It's just and we have a whole industry, and there's so many bad parts of our industry. And part of the blame is parts of our industry that actually make it seem like there shouldn't be volatility.
Yes. Yeah, that's right.
It's a naturally occurring thing. It's a naturally occurring thing. You cannot have average returns of 9.08% per annum. From 2005 to 2019, you cannot have that without it going backwards at some stage.
That's right. Yeah.
Like if someone was to say we give you guaranteed 9% rates of return, like term deposit, like it just doesn't occur. The guaranteed rate of return right now is 2%, or thereabouts, and it's the term deposit rate for 12 months. So yes, if you put $100,000 into a term deposit on January 1, and the rate's 2%, you know that you'll get 2%.
Yes.
You'll have $102,000 by the time 31st of December comes around. Now, it's just such a low rate of return because of that guaranteed nature. Like people will accept a lower rate of return for guaranteed nature. So you cannot get, which a lot, 97% of clients actually need returns that we say higher than 8% to achieve their goals and objectives, and that's not. That's the people that we see. That's not necessarily everyone. That's the people that we see. So they're just not available without some volatility. Now, volatility is not something to be worried about. So if we go back to the global financial crisis, I've just run some numbers here. Like I said before, from 2005 to 2019 financial years, average rate of return of those 60% weighting, largest 200 companies in Australia, 40% weighting, largest 1,500 companies in the world, unhedged to the Australian dollar, 9.08% per annum. What I've looked at is that to the 30th of June 2009, from the 2005 financial year, what average rate of return would you have gotten? To just after, almost at the bottom of the global financial crisis, so almost at the bottom of the cycle. So March 2009 was the absolute bottom of the cycle. So we're looking at returns till just after that, the 30th of June 2009. bearing in mind that's just after the GFC bottom.
Yep.
So financial year returns for that weighting of companies, if you started that in 2005, 14.86% was your 2005 return. 2006 return, 22.48%. 2007 return, 21.3%. All of those returns are above average. So when you have above average returns, you then have below average returns at some stage.
That's exactly what the point you're making is that you cannot have those above average returns without those below average returns.
That's right.
It's a similar thing of saying we can't have everyone being an above average driver. It's not how it works.
68% of people claim that they're above average drivers. It just can't be.
No, that's right. So you cannot have that 22.5% return in that year and the 21% return the next year without then having that next year, which I think that's what you're getting to, is that next year, the 2008 year, 15.78% negative return.
That's right. So for 2008 financial year, minus 15.78%. For 2009 year, minus 19.78%. Bearing in mind that at some stage during that year, it was down lower than that. So in 2010 financial year was actually a positive of 10.36%. Now 2010 financial year actually, 2009 financial year we're talking about here, ended on the 30th of 6th 2009. So the average, so the total return that you received from the 2005 financial year till just after the global financial crisis, which ended on the 30th of June 2009, was a sum total return of 33.44% positive. So just with that extra bit of time.
So if you could go back in time and say to someone, in 2005, do you want to have money in the bank, or do you want to have money invested in companies? Most people would say, no, I want the money in the bank because the GFC is coming. And what you're saying here is that they would still be better off.
People always they would be better off by they would absolutely be better off. The cumulative return over that period of time was 33.44%. Which over that few of years would certainly outpace what money in the bank was. Now you get the good with the bad. That's what people forget. So you got 14.86%, then you got 22.48%, then you got 21.3%. So that gets you to a pretty good position. Then it falls from that really good position by 57%. But then it starts to increase straight away again from there.
This is the one that it shouldn't be surprising, but so for most people that don't work in this day in, day out, it's probably a bit, it would blow you away a bit to think that from the bottom of the GFC in March 2009, over that last sort of 10 years, the return, there has been 1 year where there was, on this sort of weighting, there was 1 year where it was a negative return of 4.4%. Every other year has been positive. So if you think about the news headlines that you read over that last 10 years, there's no way that you read a news headline or saw something that said, geez, things are going pretty good. There's none of that. There's no way.
There's none of that.
I feel like now we're going to digress into a thing about Greece and fiscal cliff and Ebola and all that, so we won't. But the point is that you can understand what drives this panic is a lot of media attention on what we would call the negative volatility, and not much attention being paid at all because to the good years or to the positive volatility.
That's right.
As you say, the volatility goes both ways. It's just that bad news sells. So there's if someone reads a newspaper that says things are going pretty good, looks like things are ticking along pretty well and they're going to keep doing that, no one's buying the newspaper tomorrow.
No, and look, there's a correlation, anecdotally, there's a correlation between people that tend to look at the value or the price of their superannuation investments too frequently. They're the type of people that generally panic because they are seeing the price move up, round and sideways, up, down and sideways. And people that I won't say people that keep up with current events, but people that put an overemphasis
on that,
on reading. I'm doing air quotes here, you can't see that, of course, news, because it's just not news a lot of the time. I mean, it's just
sensationalised.
It's sensationalised.
Yeah, but I guess, and that's kind of the point of where we see our role working with people on an ongoing basis is this second portion of this, the panicking thing, is that it's a big part of what we talk to people about, is making sure that we are communicating a point of view that is completely rational and objective, which is not what you're seeing on the evening news.
Yes.
And that's kind of where we've come back to, for most people, they need to be invested in these assets. They need to be invested in a way where they're not going to be under-diversified and they're not going to be wiped out by one company or one sector going pear-shaped. And then the second part of that is then they need to not panic.
Yes, yeah, that's the big one, because that style of investor that we just described before was volatile.
Yeah.
It wasn't risky.
Yeah.
It was volatile.
Yeah.
Now, if you panicked at the wrong time,
you
never recovered from that.
No, that's right.
Because you did,
Well, you
sell for 43 cents
and then tried to buy it back.
And try to buy back in for $1.
Yes, that's right. It's. I think just before we wrap that up, I feel like we're going to end up going for 3 hours if we don't wrap it up at some stage. But the point that we make there with the panic, and you touched on this before, when we talk about companies and shares as interchangeable, we'll talk about investing in shares, investing in companies, and in our mind, that is interchangeable. A share is just a part ownership of a company. So
that's
Woolworths
right.
is a company. You own a share of Woolworths. You own a part of the company Woolworths.
Yes.
And so that's where I think a lot of people panic, is that you're forgetting that you own an asset, you own a real thing. And that's kind of where I can understand people's love affair with residential property, because if I buy a house down the street, I can drive down past it every day and I can look at it and go, my house is still there, it's all okay. Yeah. If you own shares in Woolworths and they have 3,000 stores across all different brands and all the rest of it, those are a few years out of those numbers, but it's probably more than that now. But if the share price of Woolworths drops by 50%, it's not because someone's gone out and firebombed half of their stores.
That's right.
They haven't burnt that to the ground. It's normally not even because their profit has taken a significant hit. It's just that, as you said, there's more people rushing for the exits. There's more sellers than buyers. I
think you're onto something there, because we spoke before about conceptually, it's easy to say I'm not selling my house that I think is worth $1 million for $600,000 because it has 5 bedrooms and 2 bathrooms. I can see all that. I'm living that. Your ownership in the largest 200 companies in Australia and the largest 1,500 companies in the world, that comes to you on one piece of paper. So it's really easy to, I think, underappreciate the level of diversification and level of far and wide reach that you have when it comes to you on one piece of paper.
That's right, and forgetting that that's backed by real assets, real businesses that are making a profit. And so that's kind of where, in the depths of that GFC, you can imagine it's easy to rush home from work, and on your way home from work, you buy $50 worth of groceries at Woolworths, and then you turn on the evening news and you read all the headlines about the world's ending. Not thinking about the fact, well, I've just went and spent $50 at Woolies.
That's right.
That money's going in. That money's coming back to me in some way as a part owner of that company.
Absolutely, and that's just one of those companies.
I'm glad you clarified that, because anytime I use Woolies as the example, people go, so I should buy shares in Woolies? Which ties back to number one, which is, we're not saying that.
Don't
we're saying
the word.
All of your ownership of these different companies, as you said, it comes on one piece of paper or it comes on a superannuation statement, and you just see one number and then a lower number. And it's easy to panic, it's easy to extrapolate, but what you really need to bear in mind is that is backed by real businesses, real companies that are doing their utmost to make a profit over the long term.
That's right. Reason 3 that people lose money in shares is that they overextend themselves. So, I mean, oftentimes that takes the form of actually borrowing too much money to buy.
So that's normally for most people, based in Townsville, the big one when we talk about you probably need to invest some of your retirement savings in shares, is the question that we get is, what about Storm? And this is exactly what you're talking about here, where the strategy of take a small amount of money, borrow a lot more and invest that money, and then borrow against the money that you've invested, and gear up as much as possible, as much money as you can borrow, and extend yourself as much as possible. And if the market, if your investments continue to go up, you will do really well.
Yes.
But if they don't go up, you are overextended. You will not be able to unwind that.
That's right. And oftentimes, when number 3 comes into play, oftentimes you see them all together. So you see people overextend themselves.
The overextension comes just before the panic.
They'll under diversify. Then they'll use all of that money to buy Netflix or Uber or God forbid Bitcoin. And then when the ensuing volatility or risk occurs, they'll actually either panic voluntarily or they'll be forced to sell out.
And that's the second part of that, is that even in a situation where you do not panic, if you have your plan in place that doesn't allow for the fact that this volatility will happen, this will be taken out of your hands. And that's kind of what you're saying. Even if you don't panic, if you have borrowed too much money and you can't service those loan repayments, you are reliant on the investment to be able to pay back that loan.
Yes.
You are setting yourself up for failure there, because you are going to be overextended when there is a crunch downwards on the prices of those assets.
That's right.
And I think that's one where we see it mainly with borrowing, and that's where I've borrowed to invest before and still borrow to invest now. It's a very useful tool. At certain ages of at a certain age, at a certain stage, and for some people it can be a very useful way to build up your net worth, but it's not for everyone, and it really is. You have to really be cautious about not overextending yourself, and so borrowing is the really easy way to overextend yourself, because it's investing money that you don't have, basically.
Yes, that's right. So no, good point. It certainly does. It does work in the right proportions. As long as you're diversified and you don't panic.
That's right.
And you have a plan of attack. So I guess
forced to sell at the wrong time.
Really, I mean, a really good way to guard against all of those things. Obviously, point 1 being under diversified, where you can be diversified. You can, apart from the example that we used of diversification amongst companies in Australia and the world, you also have to have some money just in normal bank accounts as well,
to meet
that you have to be able to fall back on at times that you need to. Having a plan of attack. So point 2, panicking. I think when people panic, they actually don't. They say if as opposed to when. So they say if there's a drop in the market. If there's volatility. And we actually, I always correct that and I say no, you mean when. So part of everyone's plan that we have, we get them geared up in their mind to expect a 30% drop at some stage.
All the time.
I
always say this too, especially over the last 10 odd years, while things have been ticking along reasonably well and there's been no significant drops, I think my clients must get sick of me saying that. Every 6 months they come in and I go, now look, your super balance is growing from 500,000 to $1 million, but you could come in 6 months' time and it could be 700. It could drop. And I think that after this many years of not being much volatility, they probably think that I'm just kidding or something.
I can see the same thing right now, and it's just by sheer weight of the fact that there have been only good years to speak of for quite some time. Look, it's one of those things that I think people have a hard time of actually believing can happen at the moment.
And I think that's obviously, we think we're the best financial planners in Australia. I think I'm number 1 and Michael's number 2. But when it scares me when I talk to people who have another advisor and they'll say something to the effect of, this guy manages, and they're normally a money manager, they're not a comprehensive financial planner. This guy manages my superannuation and it goes up every year, so I'm pretty happy with it. And you go, he is either investing that in a way that's going to grow the most over the long term, and with that is going to come some years of negative return, or he is not investing that aggressively enough to grow for the long term. You can't have it both ways. He cannot be investing that money in a way that it's maximising your growth over the next 20 years, while at the same time never going to have a backwards year. So
that's right.
When people say that to me, it scares me, because I'm going, at some stage he is going to have a negative, like your advisor, meanwhile your underlying assets are going to have a year where the balance drops temporarily.
Yes.
And that's what scares me, is that if you don't have a plan in place and you're not emotionally ready for that, that is when you're most likely to panic and sell.
That's right.
And that's kind of why we are on the side of going overboard with these, what we call lifeboat drills of, this is going to happen. Your investments are going to drop by 30-40% at some stage in the future.
Yep.
You need to get your head around that. You need to be ready for that. You need to be prepared for that. And we talk about it constantly with all of our clients every time we have a progress meeting with them.
Yeah, you're a little bit late if you talk to them when it's actually occurring, and say, look, now what I'd recommend is that you just stick to the strategy. We tell people straight away that is going to happen at some stage. And now they look at us with blank looks on their face. because the returns have been. I won't say the returns haven't been exceptional. They've been on average, but it's just been no volatility. In the in the last 7 or 8 years. There's been hardly anything. So look, it will happen at some stage. We tell people that we're going to stick to the strategy. So whatever they're salary sacrificing to superannuation, or whatever they're contributing to their investment, or whatever that strategy is, we're not going to change that. We're not going to try and sell out at the top. We're not going to try and buy back into the bottom. We're not going to change the investment strategy. We're just going to treat things as if nothing has happened, which is the way to do that, because you'll actually be buying more at a lower price. I do have some clients that have money on the side ready to go. Not that we advocate trying to time the market, but they've got a line of credit against their house that they've paid off, and they're actually rubbing their hands together for a drop of 20 or 30% because they actually want to buy up at that point in time.
Price, which is a cardinal sin of financial planning, the market timing.
It's funny because they're contributing money as well.
Yes. So and I think that's probably another podcast all of its own is the market timing thing.
We don't want to digress too much, but
the theory there is that if you have all of your money in superannuation invested fully, and you are on track to be where you need to be to retire, if the market continues to go up and up and up, well then that's great. But what you're saying there is in some cases, and it ties back into that overextended I guess risk, is that there will be a drop at some point in time, and if you are able to take advantage of that, and for most people, as you're saying, that salary sacrifice every week or every fortnight, or that contribution to super, or however you do that, that is taking advantage of that volatility.
That's right.
So whether you sit with a bit of cash on the sidelines, or whether you just keep doing your contributions into super, you are really taking advantage of that negative volatility, rather than I guess being buffeted by those wins, if that makes sense.
That's right. Yeah, and certainly point 3, don't overextend yourself. So, we've got plenty of examples of prudent borrowing to invest. So these particular people that I'm thinking of had just paid their mortgage out. When they started, and we borrowed $200,000 against their house, we invested that money. We treated it as if it was a mortgage.
Yes, and just paid it off.
They paid it off over the last 7 years. So really, really good with their disposable income now. Over that stage, because they'd reinvested dividends, their investment of $200,000 funded by the $200,000 loan. Had actually grown to circa $400,000 at the same time that they were paying their loan off. So the borrowing actually just allowed them. It was a prudent level for them. Because they could afford.
It's funny because I've got. I was going to use a very similar example where I've got clients with exactly the same situation, where when they first came in, they had just paid off their mortgage. We borrowed $200,000, and the reason that we knew they weren't going to be overextended is because they'd just paid off a $200,000 mortgage over so many years. So we basically looked at that and went, "You've been doing that for 10 years. Let's continue to do that for the next 10 years." So that's, I guess, the big thing, the difference between prudent borrowing and
just
overextending.
Well, I'm thinking of these particular clients. They could afford to make repayments of about $50,000 a year, so $1,000 a week.
Yeah.
Quite quickly they paid off that $200,000 loan. Now an example of overextending would have been to say, hey, interest rates are at 5%. We can borrow $1 million here. Let's invest $1 million and pay interest only, which is $50,000. And that's an example of being overextended in that scenario. So it was just a prudent level for them.
Yeah, that's right. So wrapping up, I think we've went through all those in great detail. I think then as we wrapped up, we went back through them all.
Yeah, so the big three again: being under diversified, panicking, or being forced out, depending on your scenario, and overextending. So and the triple whammy is that you often see those three together.
That's right.
And that's where people really do get themselves into trouble.
I think we've covered all bases. As we said, there's 1,000,001 ways to lose money investing in anything, but when you're investing in shares, I think most of the time it ties back to one of those three things. So when you're coming up with a plan for your retirement savings, as we said, we've got to back into it and go, we need to be invested in a way that's going to get us a long-term return. How do we avoid these three major things that pop up?
Yes, that's right. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.